Today's obviously a red day in the stock market, but a lot of institutions on Wall Street are saying, don't worry, this is just a slowdown, it's oversold, and it's not something you should be worried about. I'm gonna go through what Wells Fargo just talked about, UBS just talked about, what Bloomberg talks about, and we'll give a little bit of historical comparisons and context to this sort of sell-off that we're seeing in markets and how it might fit into the future. Because right now, the future, at least in terms of expectations, doesn't look that bright, at least based on expectations of consumers. The University of Michigan final read for March is out from the preliminary report 2 weeks ago. It came in worse than the preliminary report from 2 weeks ago. And the summary is here that, quote, expectations have plunged a precipitous 18% from February, now losing more than 30% since November. This occurred across all demographic and political affiliations, including Republicans joining independents and Democrats in expressing worsening expectations since February for their personal finances, business conditions, unemployment, and inflation. Nearly 2/3 of consumers expect unemployment to rise. This is now the highest reading since 2009 and the highest inflation expectation since November of 2022. However, seeing this 5 handle on the year ahead expectations isn't actually what's most concerning. What's most concerning is right here. The long end of the needle has become unanchored, well, to some extent at least. Remember, every time Jerome Powell talks to us, he tells us, hey, the good news is inflation expectations are still well anchored. You realize that is actually a critical component of Federal Reserve monetary policy transmission. In English, for things to stay good, the Fed wants you to believe that things are going to be good because they realize there's a transmission from expectations to what reality is. And this is why we've regularly heard Jerome Powell tell us, it's okay, it's okay. Long-run inflation expectations remain well anchored. If you've ever watched a single Fed meeting, you know that's what he says. It's not what he sounds like, that's someone else, but you know what he says. And this de-anchoring right here is an early warning sign. Now, I mean, Jay Powell could sort of cast this aside and say, oh, yeah, it doesn't matter. You know, it's just a 1 month read. That could go away next month if we come up with a tariff resolution, which is true. So I expect them to sort of cast this aside for a while. But it's interesting. This morning in our course member live stream, remember you could join the membership over at meetkevin.com before the price goes up. And you lock in that price forever. But this morning we were talking about how stagflation usually ends in recession, and it makes logical sense. When you have stagflation, you usually break that with higher rates until you break inflation completely, and that usually is what results into a negative growth shock, and therefore you end up with negative GDP. Now, so far this is just bad news. I said we were going to talk about how it's overblown and buy the dip in just a moment, and we're going to do that, but first I have to pile on a little bit more bad. Not because I want to, but because the data is what it is. You know, I already know people do the whole like, oh, but Kevin, you're just trying to be a bear. No, actually, just report the news with what I think is a relatively neutral perspective that 80% of people can enjoy. And if, you know, some extreme edges don't like it, well, I'm sure they'll let me know in the comments. But I'll keep trying to provide as much of the truth as possible. And the truth right now, at least according to the Atlanta Fed real GDP indicator, which has been pretty damn accurate so far, is telling us that the data we just got has actually worsened the outlook for Q1. See, just yesterday, the Atlanta Fed gold-adjusted GDP Now indicator was sitting at positive 0.2%. That was revised down from the positive 0.4% on the gold-adjusted GDP Now. Now, this has actually sunk to negative 0.5%. Which means right now, GDP estimates for the first quarter, which the first quarter ends, you know, in 2 days here, or 3 days, is basically trending negative, which isn't great, because that could set up for potentially a second quarter of a negative GDP as well, and that's when we have technically a technical recession. The question is, will people continue to spend through it? So far, the upshot is that the answer has been yes. Federal Reserve officials are right to say that people are still, according to credit card spending data, spending well. A lot of this harkens to the JP Morgan credit card spend data from March. But I have a problem with using the JP Morgan credit card spending data because it does not represent a broad swath of the American consumer. It represents a sliver of a wealthier cohort of banked individuals. You know, there are non-banked individuals. There are, individuals who are banked at completely different institutions, regardless of their net worth. And there are just some people who can't even open the door at JPM because, well, frankly, their credit card standards are too high. It's too restrictive to open up an account there for credit card spending purposes. So we've talked about this before, and when we look at the granular details of the JP Morgan spending data, we also find that it's really Gen Z and millennials that are propping up where credit card spending, whereas Gen X and boomers are basically flat to barely growing. And this isn't even inflation adjusted yet, then we'd be negative. But the problem with that is the people who have actually been through hard times before, who've personally lost a home or, lost throughout a recession or lost a job or whatever, those are, or lost a business, my goodness, those are people who are scarred. And I think those are the folks who are starting to pull back on spending. I pulled back last July because I'm like, oh, this isn't good. Y'all already know that. We're going to get to some of the good news in just a moment. But we were also talking in the course live this morning about how part of that may be because of my scarring as a child when, we basically went from having nothing to finally having a pool home in a nice neighborhood because business was doing well, and then losing my childhood home. And I know the feeling, the scar that is inside of me and how horrible that is to basically get rug pulled and go from a neighborhood with family and friends and a nice sort of normal American lifestyle, basically into small apartment we could barely afford and losing our car because not only, well, did it break down, but then when we fixed it and then we couldn't make the payments on it anymore and we lost that and I started walking to school, which, fine. People had to do that in history too, but I'm just saying those scars, they last. And I think that's why you could see a generational divide between older millennials, Gen X, and boomers compared to Gen Z, who has only ever lived through buy the dip. All right, so Bloomberg, though, and this is where we get to some of the upshot. Bloomberg suggests, look, the labor market's still okay. Okay, we've heard that argument a million times before. When the labor market rolls over, it's too late. Okay, when every company starts announcing 20% layoffs because there's some shock, you're not going to care about the unemployment claims data. You're not going to care about the next month's BLS labor report. You'll already know. You'll already know that we're in the poops. And it's too late at that point. You can't wait for that data. It's lagging data, right? So, Bloomberg suggests, hey, there is also a risk, though, of utilizing these sentiment surveys, because with the sentiment surveys, they don't necessarily forecast what the stock market is going to do. There's a very weak correlation. There's actually more of a correlation with negative sentiment and stocks going up. So that is an argument people use for buy the dip. It's like, hey, well, people are fearful, you should buy. But the question is, people might be fearful, is blood on the streets? Now, UBS says, equities might be getting ahead of themselves a little bit with the sell-off. UBS has a whole piece out on how equities are pricing ahead of fundamentals. However, UBS does argue that the fundamentals are deteriorating. So, we have to be aware that, while we could say, hey, maybe we're just getting ahead of ourselves here and we're overpricing some of this adjustment here, it's worth remembering that companies generate earnings, and the reasons they have the valuations that they do is because of projections for earnings. So here's the UBS piece where they suggest the market pricing derating is ahead of fundamentals right now. So in other words, the sell-off has gone too far. They actually expect a tactical recovery. However, they see concerns about renewed weakness unless earnings expectations stabilize and policy uncertainty abates. So in other words, while we could have oh wow, CoreWeave shares open at $39 versus the IPO price of $40. Oh man, that's going to be entertaining, especially since NVIDIA is backstopping them at $40. I don't like that one. I made a couple videos on it over the last few days. I'm like, I don't know, folks. This This could be a canary. We'll see. We'll see. Usually the IPOs pop, though. You know, you do the face ripping. Oh, 50% up on IPO day. Anyway, so this is interesting from UBS because what they're really telling you is in order for you to really believe that the stock market is going to sustainably stay up, you need not only earnings expectations to stabilize, but you also need policy uncertainty to slow. And I think that uncertainty is why, at least in part, quick update on the House Act fundraising, we're almost at $3 million in a week, which is pretty incredible. If we include the Reg D, probably. I mean, that's pretty incredible for less than a week, and we haven't even done our dedicated video yet on the main channel. That's pretty good. You know, it was within the first, what was it, like 36 hours or whatever, we broke 7 figures. Now we're about to cross $3 million already for this uncertain of a market. I think it's a sign people are really looking to diversify. So for us, we look at that and we're like, okay, that's like 6 wedge deals. You know, 6 wedge deals. It's like we could turn that into 600K of profit on that. Right? That's our goal. Anyway, check out House Hack over at househack.com. But that's just a little update for you. I think it's incredible. I mean, we tripled our first week, our first 36-hour period of fundraising within the first week. Pretty incredible. So we're only on day 7 now of mentioning that the non-accredited round is available at househack.com. Read that, read the disclosures and the offering circulars and all that. But it's kind of cool. And it's just crazy because it's happening in this environment where stocks are selling off so much. I think it's because people realize, we are a hedge to this equity market insanity. You get 5%, all of the upside and downside protection, 5% yield plus upside and stuff. It's a good deal. That's why I put $5 million of my own money into, the November round, which obviously I'm not counting as part of this right here. So this idea, though, about earnings expectations stabilizing, it's tough because really not only do you need the tariff war to calm, but you really also need analysts to be able to determine the impact of whatever tariffs we settle on individual companies. And that can sometimes be a little bit more challenging. One thing that I think is very interesting is there was some commentary about tariffs this morning. And the commentary on tariffs this morning was, oh yeah, right here. So it had to do with BMW raising prices. And there was an individual that said, oh, it looks like BMW is only raising prices by about 4% on these various different models. And I replied to that tweet or post, whatever you want to call it. Donald Trump right now saying, we'll absolutely follow through with tariff promise on Canada. However, things are going to work out very well with Canada. We had a very good talk with Carney. All right, well, those updates are pushing, I think, the Qs just a smidgen back up. I will absolutely follow through with tariff promise on Canada. Yeah, interesting. But anyway, what's worth remembering is these numbers showing you an increase of about 4% on 25% tariffs is not the way to think about it. This 4% increase is actually on 0% of a tariff. Because remember, vehicles sit in inventory for about 2 to 3 months. And when vehicles sit in inventory for 2 to 3 months, especially, a pre-tariff stock up, you might actually have more than 2 to 3 months of inventories built up. Those vehicles getting their prices increased by 4% is actually a 4% increase on 0. So just wait, when the full impact of U.S. tariffs plus European retaliatory tariffs plus U.S. retaliatory tariffs hit, not ideal. Now, I hope we go back to free trade, and I actually project that we will go back to free trade at some point. Either during the Trump administration, we will go back to free trade, or within the first 6 months of, if Trump doesn't do bring free trade back, then probably the first 6 months of what will likely be a Democratic administration in 2028. But what's fascinating here is SocGen had some talks about this as well. They say, let's see here. Oh, they were talking about how Canada is looking to go back to free trade within Canada itself, and how there's a $250 billion opportunity within Canada to go back to free trade. And they really talk about how, hey, free trade is the direction to go, and there are benefits within countries, and of course for the United States and the globe as well. And eventually, I think the expectation for everyone is that we will get to free trade. Maybe this is just sort of a means to get to the end. I don't know if they justify the end, but we'll see. However, that said, unlike UBS, SocGen is a little bit more bearish. In fact, their headline is that they, quote, caution investors about buying the dip at the 200-day moving average, which is interesting. Usually I like to buy when all of the analysts are panicking, and so far I don't see a lot of analysts panicking, but SocGen is a little negative. You know, they say, here, what do they got? Hence, when the U.S. S&P 500 dove below its 200-day moving average in early March, investor nervousness increased markedly, as did recession fears. We may well be in a new bear market, and the recent rally from March 13th, back above the 200-day moving average, may prove to only be a technical rally from very oversold levels. Certainly, bull-bear sentiment indicators were extremely washed out and crying for a rally. If the market fails to hold above the 200-day moving average, you can expect recession chatter to quickly resurface. Wow. Okay, well, obviously a little bit on the bearish side there. But then again, there is a lot of enthusiasm. I mean, if you turn on CNBC, it's almost daily. I mean, I shouldn't even say daily. It's almost like minute by minute that all you hear is people talking about, valuations have already come down. It's time to buy the dip. Maybe it is, but it depends. Is it right for you is the question. Here is just so you know what I'm using the SPY ETF here as a way of proxying the S&P 500. And you can see the 200-day moving average right here, this orange line. 200-day moving average right now sits at about 570, so we're a little bit below that right now on the day moving average. You can see we tried to break above it, but so far we failed to hold it, which in my opinion brings us right back to this 550 line. Speaking of which, with the lines, would you look at this? In this morning's alpha report that I sent to course members, I mentioned that if we lose 476 on the Qs, we'd probably go to 469. And we literally did exactly that. We literally plowed through 476 and went through to 469. And then on Tesla, what's remarkable is I mentioned if we lose the 274 line over here, we could be touching 260, which is crazy because look at this. We got within 10 cents of the 260 line. Remember, you can get all those with the Meet Kevin membership over at meetkevin.com. Okay, so there's more though. There's a lot more to this that's worth discussing, and it's important to pay attention to this. The durable good orders and some of the latest data have started leading to an increase in credit default swaps. Some people refer to this as as basically credit spreads. Now, if you zoom all the way back out to 2013, you can see we're nowhere near at the shock levels we've previously seen, but you usually don't see these peaks until you're actually in a real shock. What's worth noting, though, is that this rise in credit default swap spreads is the highest level that we've seen in terms of a spike since the beginning of 2022 when we started raising rates. So it's not that this is way lower than these because the shock is just beginning. It's a way of showing you that a big shock is beginning. One similar to what we saw when the Fed decided to start raising rates and getting bearish at the beginning of 2022. You're seeing a similar spike now. And this is the high yield credit default swap 5-year spread. Okay, in English, the bros are demanding more insurance against junk bonds defaulting or high-yielding corporates defaulting. Okay, that was English. Now let's go 5th grade level.
Yo, people buy more insurance because they think things about to break down.
Okay. So, it's interesting. This is really just started within the last few days here, and it's something that I pay attention to because this is the highest spike since the beginning of 2022, and it's easy to sort of wash that aside, because you do have UBS suggesting that indicators such as PMIs and leading indicators like the CLIs don't yet really reflect a recession. However, market-based measures suggest there is an uptick in recession risk. And Wells Fargo says that Q1 is setting up to be, quote, ugly. But maybe it's not that bad because February inventories don't indicate that's stocking up yet. Okay, well, let's be real. The inventory measures that we got this week are from February. When did the trade war really get bad? March. So if the trade war really got bad in March, and Wells Fargo's like, Q1's not that bad because inventory buildup in February wasn't that big of a deal. Bro, what are you guys analyzing? I know we've been talking about tariffs forever, but when did it really get bad? March. Where have you been, Wells Fargo? Anyway, remember, business is very simple. When PP goes down, pricing power goes down, margins at businesses go down, and then layoffs follow. It's a cycle. Eventually, PP will go up again. I'm very happy that eventually PP is going to go up again. Now, sometimes there are people who would rather have no PP than small PP. So, otherwise though, it's a cycle. You get PP down, and then PP goes up. Cycle. All right, so we talked about Atlanta Fed, we talked about credit default swaps, we talked about UBS, we talked about Wells Fargo, we talked about Bloomberg. You can see just how noisy this is. There's a lot of this, especially since you've got this talk about Donald Trump potentially in almost an authoritarian way threatening companies not to raise prices because of the vehicle trade war, which I think is kind of ludicrous because the trade war imbalances that we're creating are insane. I mean, look at this chart here. I'm cutting it off a little bit. There we go. Look at this chart. I mean, Trump, this just shows you an example of trade balance here. The black line is our trade balance. And it plummets massively into deficit over here because now we're importing even more. We're actually making the trade problem worse because we're like, oh my gosh, quickly import more before tariffs. Actually exacerbating the shock right now. Of course, as we've talked about before, the argument is, Donald Trump is going to, detox the economy. The problem is, how much damage is that going to cause? To be determined. So we'll see. Mexico's economy, by the way, is almost certainly going to go into recession. In the fourth quarter, they already shrank, 0.6%. In January, they're at negative 0.2%. Some of that is due to structural changes inside of Mexico, budget deficits, cuts to fiscal spending, 2% of GDP cuts is, some of the largest levels of cutting that they've wanted to do, constitutional reforms. They're trying to change a lot, but they're just pointing the finger at Trump. I mean, it's an easy thing for Claudia Sheinberg to do because, trade with Mexico or exports from Mexico make up 35% of the Mexican economy. So you need those USMCA exports. So of course tariffs disproportionately affect Mexico, but they just worsen something that's already been getting bad. So Trump doesn't deserve the full blame for a Mexican recession. But Claudia Sheinberg's going to say it's all Trump's fault. But then again, she's a politician, and that's what you would expect them to do. I've gotten, honestly, since 2021, I've gotten so disappointed in politics that it's just, on a daily basis, becomes more and more disgusting to me. I don't know if it's because, as I get older, then I was a youthful 29-year-old. Now I'm 33. Those 4 years make a big difference. But kind of crazy. So anyway, that's a little bit of an update in terms of why the hell the market is selling off the way it is, and trying to provide a little bit of a balanced take there. But where I stand on the bull bear scale. I'm like a 2.9, and it ain't getting better. It's certainly, I haven't seen it cross 5, since the Nike swoosh days. But we'll see how it all goes. We'll keep bringing data to you. So thanks for watching.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.